Hey, everybody. This is Kirk Kinder from Picket Fence Financial. And we're just going to talk this month a little bit about what's going on in the markets. And let me tell you, it has been a rough September and early part of October. So there's a lot of people getting pretty nervous about the markets. Just wondering if this is going to be symptomatic of a bigger downturn or if this is just kind of normal market volatility. Now, I'm going to tell you right now, I don't have the answer. I don't know. So we're just going to kind of take a look at some of the situations as I see it, and also some of the moves that I've made recently, just so you can get an idea. Maybe you can find it useful in your own portfolio. Anyway, so what's causing the markets to get a little bit jittery? Why was September such a bad month, and why has October been so volatile? I think one reason, and you don't hear this a lot in the press, but it's really the end of quantitative easing. So the Federal Reserve has been basically, for lack of a better word, printing money. What they have done is they have been buying assets from banks. So the banks they can take bad mortgages, they can take bad loans, they can take any kind of asset, give it to the Fed as collateral, and the Fed hands them some fresh, clean money, which technically goes to banking reserves. They started this way back in December of '08, and they've had several sessions of it since that period. And what this chart shows you is what's kind of happened when the Fed implements quantitative easing and what happens when quantitative easing ends. You can kind of see quantitative easing the first time began in December of '08. The market loved it, went up 42%. And then when quantitative easing ended, the market came back about 11%. When the market came back that far, the Fed jumped back in with QE2. And that was in November 2010. And from that point until QE2 ended, market went up about 24%. QE2 ended, down went the market, 14%. Then they had something called Operation Twist. It was basically QE, but not like the other first two programs. But when they did that, market up 20%. They stopped that, market dropped 6%. And since QE3 happened late in 2012, the market's been up 16% from there. So what you can see is when QE's on, the market goes up, and when QE goes off, market goes down. This month is the last month of any quantitative easing from the Fed. I think it's October 21st is the last infusion from the Fed. So after that, they're stopping their QE. Now interest rates are still at historically low rates, 0.25% for the Fed funds rate, but the QE is going to end. So typically when this has happened, the market has pulled back. So maybe that is one reason why the markets have pulled back in September and October. Nobody knows. I think it probably is a big contributor to it. Maybe not the only one. Another thing that I've been saying for really a year and a half now is valuations are very high. And I think at some point, the market returns are going to coincide with what the valuations of the market are. This chart has been taken from Doug Short. He's got some great data on his website. You go to dshort.com. But basically, he follows really 4 valuation metrics. The first one is a Crestmont, which is a money management firm. They look at the price to earnings of the market, cyclically adjusted over the past 10 years, and they also factor in certain things such as depreciation and amortization. So they have their own method of really trying to understand what real earnings are for companies. Then you have the Robert Shiller CAPE, which is the cyclically adjusted price to earnings. That isn't adjusted anyway like the Crestmont P&E, but it's still over a 10-year period where earnings are taking adjusted for inflation. So it smooths out the earnings cycle. Then you have the Q ratio. And the Q ratio, what it basically does is it tells you, is it cheaper to start a company today from scratch, or is it cheaper to buy a company? So if you were looking to, and nobody's going to do this, but if you were looking to buy McDonald's, would you be better off starting from scratch and building the assets, buying the land, or would you be better off just buying McDonald's outright. So really what it's looking at is the price of the company relative to its assets. Then he just tracks the S&P 500 composite from its mean. He regresses it back to the mean. But what this chart really should show you, without getting into all the different valuation metrics, you can see that the market right now is as expensive as it's ever been, with the exception of 1929 and 2000. So, this just isn't really a good thing. I'm not implying that you're going to see a market downturn like we saw in 1929 or what we saw in 2000, but what valuation does is it gives you an excellent indicator of what future returns are going to be. Just to hit on one more valuation metric, Warren Buffett always talks about the total U.S. stock market capitalization compared to the size of our economy. So when you think about it, all of the publicly traded companies out there, they're not the whole economy. I mean, there are hundreds of thousands of small businesses. There's government overlays. There's all kinds of things out there that aren't included in the publicly traded companies. So when the publicly traded companies are as large as the size of our economy, that kind of tells you, things are getting a little bit overvalued. Again, the key takeaway from this chart is the only time the market's been more expensive than it is today, dating all the way back to the 40s, is in 2000. We're more expensive than we were in 2007. And we're also more expensive than we were way back in the 70s, right before that brutal bear market. So valuations are very high. And again, like I've been saying, it doesn't mean that there's going to be a big market downturn. It doesn't mean there's going to be a crash. Nothing like that. What valuations tell you is what can you expect as an investor going forward. This is a great chart. If you look at the cyclically adjusted price to earnings ratio, over the short term, anything can happen. So what this chart does, it looks at 1 year, 3 year, 5 year, and 10 year for various CAPE numbers. So the green numbers are when the CAPE is between 0 and 10, purple is 10 to 15, light blue is 15 to 20, orange 20 to 25, and then dark blue is 25 and above. And right now the CAPE value is at 26. So what you can see is over the short term, 1 to 3 years, anything can happen. Nobody knows exactly what's going to happen with the returns. But when you start to look at 5 and 10 years, it really shows you that valuations drive the bus. So the level that we're at right now, we could expect from the U.S. stocks a negative 2.5% return annualized for the next 10 years. So again, who knows if that's going to happen? What we're just saying, historically, this is what has happened. But I think what people need to start to realize is when you get valuations like this, you're not going to get the returns that you've gotten previously with lower valuations. And usually that's going to manifest itself in higher volatility. There's some other worrisome signs right now with the markets. And the big one's volatility. I mean, we've had some big moves up and big moves down. In fact, with the Dow Jones Industrial Average, we've seen more 200-point moves in the past 2 weeks than we've seen in the past 2 years. So whether you like it or not, volatility is back. And, unless things really settle down quite a bit, we're probably going to see volatility going forward. The other big thing, kind of worrisome, is when you look at, say, the S&P 500, what you want to see when the S&P 500 is going up, you want to see the majority of the 500 stocks in that index outperforming the index itself. Well, right now we actually see the opposite happening. Only 30% of the companies in the S&P 500 are outperforming the index. So that means it's fewer and fewer companies that are carrying the weight. Just for kind of a comparison purposes, 2007 was, at the peak of 2007, was about 35% of the stocks were outperforming the index. The other thing is small company stocks, small caps, tend to lead the broader market, both up and down. So last year when the market had a really good year, small cap stocks did really well. But this year so far, small cap stocks are down for the year. Again, it doesn't mean that that's what's going to happen. Nobody knows what's going to happen in the markets. We're just trying to look for trends and see what's the reason for all of the volatility and the recent moves in the market. Now, there are good signs too. So there are some things that, when you look at it, reasons to be optimistic with stocks. The first one's a presidential cycle. So when you get the presidential cycle, year two, the fourth quarter of year two has historically been the best quarter for stocks in our nation's history. So, if history holds from October to December this year, we should have a very good quarter for stocks. The other thing is, I still believe that if the volatility continues to go and we see a pullback of 10, 11, 12% in the markets, I don't think the Fed's going to sit idly by and let this happen. The first chart I showed you where the Fed would step in with different QE programs, they are so hypersensitive to the move of the markets that, if we see a 10% decline, we might see them reenact quantitative easing. So even though things could be rough here for the next month or so, I have a feeling that the Fed will probably come in and start some QE, which the markets would love. But one of the things I'm doing is just kind of watching technical indicators on various holdings. And the big one is just looking at the 200-day moving average. This chart was taken from Doug Short again, and it's kind of based on the work of Meb Faber. And what we're looking at is, what if you just bought the S&P 500 and you held it all the way from 1900 through 2008? What kind of annualized returns would you get? What kind of risk would you have? What if you did this, but anytime it violated and went below the 200-day moving average, you sold and went to cash? Well, what this shows you is the annualized return for the buy and hold was about 9.2%, whereas with the 200-day moving average, you're looking at a little bit over 10%. Now that's statistically insignificant to me, but what isn't is the volatility. So the volatility drops by a third when you use the 200-day moving average. So it's kind of a way to get a similar return with less ups and downs. So what I've been doing is just kind of watching the 200-day moving average for various indexes. This tactic works for international stocks. So here you can see again, we get about a third less risk with a little bit better return. It works with commodities. Here you actually get sizable increase in your performance with about 17% less risk. It also works for real estate investment trust. So again, you're looking at almost a third of an increase in your return by using the 200-day moving average, and you're also looking at about a third less volatility. So based on all that, what I started to do in the beginning of October was I started to get out of international stocks. I sold emerging, I sold our Europe, I sold our Pacific holdings. Again, they violated the 200-day moving average, so I'll just go to the sidelines. So I'm going to sit in short-term bonds. Now, if they move back up, if they go across that, I'll look to get back in. But for right now, we'll just kind of sit, wait, and see what happens. I also sold commodities. Commodities have taken a big I own a position in Plum Creek Timber usually. I sold the lumber. I sold all our other general commodities. The only thing I have still continued to hold was a small position in gold. I'm still holding U.S. stocks. They haven't violated the 200-day moving average yet. If they do, I'll sell and kind of wait and see what happens. But right now, I'm still fully vested in again, I should say large cap U.S. stocks. I don't own any small cap stocks. I actually sold those last year, but I am holding on to the large cap U.S. stocks. Like I said before, if these markets tend to improve, if we do see the Fed step back in, or if we see the presidential cycle take hold and the markets come back up, we'll get back in. But this is just a risk measurement to take to ensure that we don't ride things all the way down if, in fact, this is a larger move to the downside. I'm still holding real estate investment trusts, mortgage REITs. I've still got master limited partnerships. If you look at some of my past webinars and some of my past letters, I'm looking at those for a couple of reasons. I think interest rate sensitive holdings are a good place to be right now. These things are paying better yields, and they're very, very interest rate sensitive. But I don't think interest rates are going to go up much from here, at least in the near term. So these are good holdings to have. Typical REITs, you can get 3 to 4% yield. The mortgage REITs are really at about 11, 12%, and master limited partnerships are yielding close to 6%. So I'm trying to pick up some extra yield in the short term. As long as interest rates stay kind of where they're at, we should be able to pick that up. And since I think interest rates are going to hold steady, I, at the beginning of this year, extended the duration on my bonds. So I increased the maturities on bonds. Again, just to get some extra yield. I'm not in any junk bonds. I'm not in any low quality bonds. Looking at high grade corporates and treasuries. But the difference between a 3-year treasury and a 10-year treasury is a little over 1.2%. So I think as long as rates stay where that, we can pick up a little extra return without having any real downside risk to it. What's kind of interesting though is I've already mentioned I got out of emerging market stocks and European as well as the Pacific region. But if we go back to what I was talking about valuations earlier, valuations reward investors over time. Low valuations, I should say, rewards investors over time. And really right now, the emerging markets in Europe are by far the cheapest in the world. This chart kind of shows you based on 4 factors where 40 countries are ranked. And they're looking at the CAPE, which again is a cyclically adjusted, looking over 10 years, adjusted for inflation, price to earnings. A cyclically adjusted price to book. So price to book is basically looking at the cost of the stock relative to its assets. Cyclically adjusted price to dividends. So here we're looking at what's the price of the stock relative to dividends. And then cyclically adjusted price to cash flow. So the cash flow of the companies. So you can see at the top, the cheapest countries are in areas you probably don't want to be invested in, like Greece, Austria, Italy, Portugal, the pigs, which I talked about, Russia, which is obviously front and center in international affairs right now, but it's a very cheap market. But you still have Spain, Ireland, Poland, Brazil. So what we're seeing, if valuations do play a factor over the next 10 years, I would expect somebody who invests in these countries is going to do better than somebody who invests in the United States. If you look all the way down near the bottom, the U.S. is between 36 and 41st in these various valuation metrics. So it's awfully expensive relative to history. And America's always got a little bit of a premium just because we're America. But the valuations are awfully high here in the U.S. So even though right now most of the pain in the market has been felt in Europe and the emerging markets, and to some degree in the Pacific region, longer term, I do expect those areas to outperform the U.S. just because of the current valuations. So those are some of the moves that I've made, some of the tactics that I use just to kind of protect on the downside. Again, when you use something like the 200-day moving average, it does not get you out at the top. It does not get you in at the bottom, but it does kind of protect against big moves down, and you do get a good portion of the upside. So if you have any questions, please feel free to contact me. You can go to my website, picketfencefinancial.com, or you can go to my blog, savingyouFromWallStreet.com. Thanks for listening.